Welcome to The Explainer. We're all about breaking down really complex topics into something you can actually get your head around. You see these monumental projects all around us, right? Things like the world's longest tunnels buried deep under the Alps, or entire new cities just springing up out of nowhere. These are literally the modern wonders of the world, amazing feats of engineering that totally redefine what we think is possible. So, the big question is, how on earth do you pay for something so ambitious, so risky, and just so mind-bogglingly expensive? Well, the answer isn't just taking out a giant loan. Nope. It lies in this really specialized world of finance, a whole toolkit designed for one purpose, to build the future. All right, let's get into it. Okay, so first things first. To really get how these huge undertakings even begin, we've got to understand a really crucial difference in how they're funded. So think about it this way. When you invest in a company, you're betting on the whole shebang. Its entire future, its balance sheet, everything it owns, for good. But project finance, totally different game. It's like funding a single epic movie production. It has a clear beginning, a middle, and an end. The money is tied only to that one project, not the entire movie studio. And this right here is the magic trick. It's the key tool they use to manage all that risk. The Special Purpose Vehicle, or SPV. So what is it? It's basically a brand new company created for just one single purpose, to build and run this one project. It's a clever way to build a financial firewall. If the project goes south, the lenders can only go after the project's assets, not the parent companies. The sponsors, they're protected. That's why you'll often hear this called off-balance sheet financing. All right, so we've got the legal structure set up. Now, every single one of these projects needs a financial blueprint, a really detailed map that's going to convince investors that this whole adventure is actually going to make them money. And that blueprint is the financial model. Honestly, this thing is the beating heart of the entire deal. It's like a crystal ball, but with spreadsheets. It forecasts every single dollar coming in and every dollar going out for the entire life of the project. We're talking from day one of construction to the final day of operation, which could be decades down the road. So the most important thing here is to follow the money. You've got to understand how cash actually flows through the project. You start with your revenues, right? Then you subtract all your operating costs and your taxes. But here, and this is the key part, you add back things that aren't actual cash, like depreciation. Now, why would you do that? Well, depreciation is great. It lowers your tax bill, but it's not real money walking out the door. By adding it back, you get to what really matters, the free cash flow. That is the lifeblood of the entire project. And here's what it looks like in practice. This is where all those numbers and assumptions come together. You can see it right there, year by year. The model is projecting the revenue, taking out the costs, and boom, there's the cash flow. That's the money that's going to be there to pay back the loans and, hopefully, make the investors a nice profit. This is literally the page that turns a wild idea into a bankable investment. But here's a thought. Is a dollar promised to you in 10 years worth the same as a dollar in your hand right now? Of course not. So investors use this really powerful tool called net present value, or NPV. What it does is it takes all those future piles of cash we just calculated and figures out what they're worth in today's money. The rule is simple. If the NPV is positive, it means the project is expected to be profitable. It's a big green light. Okay, but let's be real. A forecast is just a best guess, isn't it? So how do you make sure your beautiful plan can actually survive when things get messy? Because that amazing financial model we just talked about, it's only as good as the assumptions you plugged into it. And the real world, well, it loves to throw curveballs, doesn't it? Politics can change. The cost of steel can skyrocket. Demand can just disappear. Any one of these things can throw a massive wrench in the works. And that is where sensitivity analysis comes in. This is how you stress test the blueprint. You basically go into the model and start messing with the numbers on purpose. What happens if fuel prices double? What if construction is delayed by 6 months? You change one thing at a time to see how much it hurts the bottom line. It's kind of like a financial fire drill. So after you run all those tests, you get something that looks like this, sometimes called a spider diagram. And what's great is that you can see instantly which variables are the big ones. In this example, look at that. A 10% change in revenue has a huge impact on the project's return, way bigger than the same change in construction costs. So what does that tell you? It tells the project managers exactly what they need to worry about the most. It's all about focusing your energy where it counts. Now, beyond just the number crunching, there's another really critical piece of this financial puzzle. How does the project actually get all the expensive stuff it needs to operate? I mean, think about it. If your project is a fleet of giant new airplanes or a network of communication satellites, these things are unbelievably expensive. Buying them all outright would just be a massive, massive drain on your capital. So, what do? They lease. It's really the ultimate buy versus rent decision, just on an epic scale. Instead of one gigantic upfront payment, the project just makes smaller, regular lease payments. This is huge because it frees up a ton of cash for other things. And depending on how you structure the deal, it can come with some really sweet tax and accounting advantages that make the whole project run that much smoother. Okay, so we've gone through a lot of complex structuring and modeling. What's the big takeaway here? What does it all boil down to? When you really get down to it, project finance is a super sophisticated way to manage risk. It's a framework that lets people chase these huge, ambitious goals by doing a few key things really well. You isolate the risk using those SPVs, you build a believable story for the future with detailed financial models, you stress test that story for weaknesses, and you use smart tools like leasing to make the whole deal more efficient. So the next time you're driving over a massive bridge or you see a new skyscraper touching the clouds, think about it. Look a little closer. Because underneath all that concrete and steel, there's a hidden financial architecture that made it all possible. And that's the framework that, quite literally, allows us to build the future.